Following a spectacular performance in 2020, when we saw gold appreciate by 27%, touching a fresh all-time high in early August, the beginning of this year hasn't been as rosy as some may have expected. With a growing optimism around economic recovery in light of the ongoing rollout of vaccination programs and stimulus measures introduced by central banks and governments, gold has come under significant pressure, correcting by 12% since the start of the year, and currently trading close to a 9-month low. Looking ahead, this period of consolidation and sideways trading we have seen lately may well continue, with further weakness likely in the short term, as gold remains under pressure by rising US yields and firmer dollar. On the other hand, the broader macroeconomic backdrop, including rising inflationary expectations, increased debt levels, and negative interest rates, remains supportive for gold. Also, the ongoing battle against the virus and the risks associated with the development of new variants, vaccines production and distribution, will continue to support gold investment demand this year. Speaking of investment, gold ETFs witnessed a record level of inflows last year at over 900 tons, taking global holdings to an all-time high. So far this year, it has been relatively quiet, with ETF investors adding just over 20 tons in January, but selling resumed last month, leading to total net outflows of some 40 tons year to date, which is quite different from a net inflow of 85 tons witnessed during the first 2 months of last year. While this is clearly not the same start to the year that we witnessed in 2020, we believe that investment in gold ETFs will remain robust this year, particularly if the road to economic recovery and return to normality prove to be more challenging. And while we may not see the same level of annual net inflows as of last year, global ETF holdings are likely to reach a fresh high at some point this year. Now turning to consumer demand, which includes jewelry fabrication and retail investment in bars and coins, the level of gold prices we saw last year and the economic downturn caused by the pandemic put a major drag on gold consumer demand, particularly in key Asian physical markets, China and India, the two largest gold consuming nations. With economies re-emerging from the COVID crisis and economic activity picking up, we expect to see a recovery in physical demand this year across all the major gold-consuming sectors, but it is likely to remain weak historically and even below the 2019 level, which itself was at multi-year low. And finally, I would like to touch upon the official sector. Last year, central banks' gold purchases dropped by more than a half year-on-year to the lowest level since 2016. And central banks even shifted to net sellers in the third quarter of last year for the first time in nearly a decade. Looking at this year, we expect central banks' net purchases to remain strong, given that broader economic backdrop remains favorable for gold, while the ongoing stimulus measures to revive the global economy will continue to support a strong case for central banks, particularly in emerging markets, to diversify their international reserves away from the US dollar in favor of gold.